Thank you for joining us again for our ongoing In the Trenches series. This is our Tuesday session, so this will be our consumer presentation for this week. If you're interested, on Thursday, we'll be talking about your compliance management system and modifications and adapting it to your response to the COVID-19 crisis. So if you need additional information, feel free to email any of the presenters or Nelson Mullins, and we're happy to send you the link for 11 o'clock at Thursday. Also, next Tuesday, we're going to be having a special presentation on the Main Street Loan Program, which is obviously a program that is designed to stack on top of the PPP loans program, the payroll protection program, paycheck protection program, rather. And so this is made for mid-sized businesses, those with greater than 500 employees. And we'll be doing a presentation specifically on the implementation and creating an operational strategy around the Main Street Loan Program. So let us know if you need the invitation for next Tuesday. As always, this presentation is being recorded. It'll be available on YouTube for your reference later, as well as all of the slides will be made available to all the participants. Obviously, the whole purpose of these is to get this information out, let it be used within the financial services industry, and that's really the goal of these In the Trenches series. Today, we're lucky to be joined by two of my colleagues. The first is Craig Nazzaro, who many of you know from these In the Trenches series. Craig was both in-house and has been in private practice with a significant focus on the mortgage sector. We're also joined by Randy Saunders from our West Virginia office, who practices in consumer financial services, litigation, and financial regulatory. And he's being assisted by Jonah Samples, who's been helping him with this presentation today. The focus today is going to be on really taking a deep dive into residential mortgages, how we do those modifications, and some of the pitfalls and stumbling blocks that all of us observed during the Great Recession and the mortgage crisis that came out of that. As we think about today, what we're really talking about is why this matters so much. And so if we look to the Mortgage Bankers Association survey that came out on April 7th, you see massive changes in the number of mortgages that are defaulting, in pre-default, those consumers that are seeking forbearances in their mortgage, where you're seeing these massive increases. So if you look at the total loans in forbearance, it went up more than tenfold over the prior week. Abandonment rates are dropping. Hold times are creeping up as individuals try to contact their servicers or lenders looking for assistance. And so what we see is this kind of wave that is going to be coming over the next few months related to residential mortgages. And our whole purpose here is to make sure you're prepared for that. You have the tools necessary to respond to it, and you avoid some of the things that caught our financial institutions during the recession. In addition, here's some of the latest information from the JP Morgan Chase earnings call that happened earlier today. What you see is that there is a massive credit reserve that's being created, and what we and the justification for that is we're seeing a huge amount of reserves that are being created to deal with defaults in the consumer sector. What we're going to do today is really focus on these different areas, mainly what we can do now, what has been changed by the CARES Act, the kind of the initial federal rollout that's helping develop some of the federal responses to the crisis. Then we'll shift into loss limit rules, regulatory concerns, some of the issues affecting servicers and sub-servicers, and finally, bureau guidance that would be particularly instructive as we try to go forward, work our way through doing mortgage modifications. This is the chart that we developed last week. If you look at consumer defaults, they tend to track unemployment. And so we don't know what's going to happen yet on default rates, but if you look at historical averages where that dark green line is unemployment, you see that single family residential tends to very closely track with unemployment. To a certain extent, credit cards do as well, less with lease, less with commercial. But most importantly for our discussion today, there's a strong correlation between the single family mortgage default rate and the unemployment rate. I ran some basic T-checks and projections of what's going to happen when we get the April reports for default. Obviously, the latest data that's come out of the St. Louis Federal Reserve is the end of 19. But if we use some standard deviation and projections, this is what we're looking at as we're going into the end of April, and that is single family. If it does trend the way it has been with unemployment, could potentially hit around 11% default rates when we get into April. Similarly, with credit cards, lease and commercial obviously are not as closely trending with unemployment. But using those forecast models in any event, even if that's off by half, we're still looking at a significant number of single-family mortgages and credit cards defaults that should be showing up as we move into April and May based on the unemployment data and the number of individuals who potentially would be defaulting. Now, let's kind of shift over. Craig, I'll turn it over to you and let you start talking about a little bit about what we can expect in the near term and as we move into the long term.
Sure. Thanks, Brad. So what we want you to take away from this call today is what we think is coming in the default spaces, how we think those default rates are going to rise, then what we can do in the next 1 to 3 months, 3 to 9 months, 6 to 12 months to prepare for that. And we have the loss mid rules to look back at, the CARES Act guidance to guide us, and also what we saw 10 years ago coming out of the Great Recession, where we stumbled, where we can possibly focus our compliance efforts to avoid those same mistakes. So in the next 1 to 3 months, we expect to see an increase in call center volume, complaints, QWRs, NOEs, as people start to inquire about loss mid options. With the unemployment rates where they are, people are going to try to see what they can do and what's available to them. As we start to see, as we've already seen the CARES Act, that Randy's going to talk about shortly, you start to get guidance from the government on what they're doing in the residential spaces, and Main Street doesn't really understand who the investor is on their loan, who owns their mortgage. So once you start to see guidance like that coming up, spikes across your board are going to start to dump. And you're going to get a lot of complaints, a lot of QWRs asking, how come I can't my mortgage, my neighbor did theirs, what's the issue here? And we generally see that early on. That's what you're going to see, from now until early summer. Then over the summer, we're going to start to see continued increased default rates. Then loans start to be referred out to foreclosure late in the summer, early fall. Once people start to stumble, historically, it's very difficult for them to catch up. If we have the forbearance agreements out there to try to put a safety net for some of the consumers, but most will come out of this okay and get back on track. But some will just we're on the edge going into the COVID-19 impact will get referred out to foreclosure, and then you'll see that spike rise, and it'll have to play itself out. Once those foreclosure referrals go out, then inevitably you start to see the increase in litigation. You'll start to see the normal foreclosure litigation quickly followed by the escalated contested foreclosure litigation that we saw and that finally started to wind down a couple of years ago. Then coming out towards 12 months out, we'll start to see the regulators coming in. Right now, we're hoping for a very relaxed supervisory cycle, that they'll come in and be a little bit open to the fact that we're being asked to change our programs. We're being asked to do loan programs such as the PPP program, roll that out within a couple weeks rather. But that is today's environment. 12 months from now, just like we saw in the Great Recession, you had the regulators asking the banks to help the consumers, lend the money out there, work with borrowers to get their loss mitigation options in front of them. Although those programs didn't exist, we worked with the government, tried to roll out loss mid options for the borrowers. We're told by the regulators that this wasn't going to be looked at so negatively. And then, come 2011, 12, the CFPB came in there, the FDIC, the OCC, and the Fed, and we started to get hammered on, UDAP issues, fair lending issues, processing issues. The loss mid rules were promulgated, and those have rolled out. So we're trying to focus on what we can do to avoid that a year from now. The next slide, Brad. So some of the steps that we can take today would include properly preparing for the volume that we're going to start to see. Focus some of your efforts now on your call center FTEs, your default servicing FTEs. as we'll see when we start to cover the loss mid rules, the rules are very hyper intensive when it comes to just high touch. They're going to have to work with the defaulting borrowers. And as that population starts to increase exponentially, your FTE demand is going to increase exponentially as well. And we'll go over that when we start to go through the loss mid rules. Take a look at your programs and options to borrowers. We want to make sure that they're defined. As the default rates have pulled back year over year for the last couple of years, we've seen less focus on the default spaces and more on core service and origination. Right, we're going to see that pendulum swing back over. Everyone's going to be focused on your default silos, what you're doing there. What if you are offering any loss rate options? What are they? A big thing you can do right now is start to define and document and publish what programs are available, why you're rolling out those programs, who are they available to, and get those into your frontline FTEs that are actually dealing with the borrowers on a day-to-day basis. You want to roll out some training around that. Make sure that they're aware of the difference between the investors, how to look that up, where in your system is the payment histories, can they access that? Just start to define that today. Also, review your loss mitigation regulations that are out there and your internal procedures to make sure. We're going to touch on in the coming slides some high-level issues that we saw around the loss mid rules and that we still continue to see, but you should have someone within your compliance verticals a little bit more focused on that currently, given the current environment. The next slide, Brad. I'm going to turn this over. This one I'm going to turn over to Randy to start to discuss the CARES Act.
Hey, thanks, Craig. Thanks, Brad. Talk a little bit about the CARES Act, which was enacted on March 27th of 2020. The first aspect, it contains an important amendment to the Fair Credit Reporting Act that immediately and possibly retroactively affects credit reporting requirements. Specifically imposes a new temporary credit reporting requirement that for many furnishers will constitute a change in the ordinary practice. I think a few of the definitions that are important to consider. First, accommodation. The term accommodation includes agreement to defer one or more payments, make partial payment, forbear any delinquent amount, modify a loan or contract, or any other assistance or relief granted to a consumer who's affected by the coronavirus disease. It also defines covered period, which means the period beginning January 31st of 2020 and then ending on the latter of either 120 days after the enactment of the Act, March 27, 2020, or 120 days after the date on which the national emergency terminates. In light of this amendment, furnishers cannot report any specific type of accommodation reached with a consumer. Rather, for consumers whose accounts were current and where they've been given an accommodation and have complied with it, their account should continue to be reported as current. For consumers whose accounts were delinquent and where they've been given an accommodation and they've complied with it, their account should and will still be reported as delinquent unless during this time period they make it current. There is one exception to the reporting. The reporting shall not apply with respect to a credit obligation or account of a consumer that's been charged off. Essentially the intent of this amendment appears to be to ensure that consumers' credit reporting is the same or better during the pandemic, and less directly to encourage accommodations for consumers who are impacted by the pandemic without adversely impacting credit. A few things to consider when looking at the effective date. The CARES Act amendment requires the change in credit reporting for accommodations given during the covered period. In turn, as I said, it defines the covered period as dating back to January 31st of 2020. What's unclear is whether the amendment could or actually does apply retroactively to credit reporting for accommodations made before March 27th. However, we think it would be prudent to assume that it does, or it could apply retroactively, and thus you should examine credit reporting for accommodations made on or after January 1st of 2020 to ensure compliance. On April 1st, 2020, the CFPB issued a policy statement. There is also guidance that was issued by the CDIA, and that guidance can be found on their website. And Brad, I apologize if you could flip 2 slides ahead for me. I went through 2 slides. This slide relates to Section 4022 of the CARES Act, and it relates to single family. There's also 4023 as a separate provision that relates to multifamily properties with federally backed loans. If we go to the next slide, I think there are 2 key provisions related to federally backed mortgage loans under the CARES Act. The first is when dealing with forbearance. A federally backed mortgage loan borrower may be granted a forbearance of 180 days for financial hardship caused by COVID-19. All that's required at this time is the borrower attest to financial hardship. The forbearance should be granted without additional documentation. At this time, it's not discretionary and may be extended for another 180 days, so for up to 360 days. No fees, penalties, or interest may be assessed beyond what would have been assessed had the borrower made payments on time. The other aspect is the foreclosure moratorium. Federally backed mortgage loan servicers are prohibited from initiating foreclosure proceedings, seeking foreclosure judgment or ordering sale, and executing a foreclosure, eviction, or sale for at least 60 days. And that 60-day period actually runs from March 18th of 2020 to May 17th of 2020. The foreclosure moratorium does not apply to vacant or abandoned property. And Craig, I'll turn it back over to you on the next slide.
Thanks, Randy. So now we want to just turn our focus to the Reg X portions that cover loss mitigation procedures. Section 1024.41 is where it starts. For those of you that are holders of the paper and servicing as well, or those of you that are just holding as an investor, the overall thing we want you to take away, if you haven't dipped your feet into the loss mitigation world before but are going to start to now given the rise in default rates, nothing within the regs imposes a duty for servicers to provide a borrower with any specific loss mitigation option. That to say, except for the CARES Act guidance that Randy just went over, this is if you own the paper. So if you're not doing any loss mit now, even though the GSEs are, you're not required to. We do ask that you weigh the reputational risk, but there's no bright line compliance test that says you have to offer a forbearance or you have to offer a modification program. Once you do, though, you're now opted into this loss mitigation regulation, and you have to abide by all timelines, the milestones, and they can be very, very detailed. So if you haven't offered loss mit options before, you're going to really want to get your head around what it takes from an FTE perspective if you are servicing your own loan. If you're outsourcing the servicing, that's a different story. But you still have other considerations to address there, and we'll talk about that later in the slide. So as I said, it's nothing that requires loss mit. A borrower may enforce the provisions of the section once you opt into loss mit, but a borrower can't make you consider them for loss mit if you're not offering any programs currently. Next slide, Brad. So now we're just going to cover on some of the broad strokes within the loss mit rules that created procedural gaps the last go-round. So where we saw a lot of litigation come from, where we saw a lot of the reputational risk come from, and the compliance findings that we saw in the last cycle of high default rates. That starts with early intervention requirements. And again, when we're going over this, think about your FTE allocations when it comes to this. So a servicer shall establish or make a good faith effort to establish live contact with a delinquent borrower no later than 36 days of a borrower's delinquency. And again, every 36 days thereafter. You may have that thoroughly handled given the fact that, the default rates are where they are, But given the numbers that Brad went over in the beginning of this presentation, realize that that live contact is going to get exponentially more difficult as those default rates rise. So what is a good faith effort to create live contact? A good faith effort to establish live contact is reasonable steps under circumstances to reach a borrower. It may include calling the borrower, sending written or electronic communications, encouraging the borrower to call you. But remember, you have to document all that. And if you're encouraging the borrower to call in, you have to have a system that can handle the volume of people calling back in. Those abandonment rates that Brad mentioned earlier from the MBA survey, as those abandonment rates rise, you'll start to see regulators looking at that. And they're going to ask, well, then how are these borrowers supposed to get in contact with you? We're advising them to call in, and they're on hold for so long that they're starting to abandon the effort. What are you doing about that? If you're not tracking your abandonment rates, start to. If you are, as they rise like that, start to get a plan in place around how you're going to address it. And you want to kind of tie that back to these faith efforts here. The more you put down a documented response, the easier it'll be to explain to a regulator how you responded to this and that you were aware of the challenges that you were facing given the shifting default landscapes. And then notice. A servicer shall provide to a borrower, a delinquent borrower, written notice no later than the 45th day of borrower's delinquency, and again, no later than 45 days after each payment due date. Again, volume's going to go up. It's going to create a logistical challenge if you're used to very low default rates. The one thing we want to highlight here is that the FDCPA kind of has an impact here. There's a partial exemption for borrowers that have provided notice under the FDCPA. So if they've called in under the Debt Collection Act and said, look, we don't want to be contacted, portions of this shift, and make sure that you're accounting for that. Make sure that your procedures and controls around the Fair Debt Collection Practices Act provide for this, and make sure that your early intervention requirements are informed by your FDCPA controls. Next slide, Brad.
Well, and let me jump in there for 1 second, Craig. I'd be remiss if I didn't. One of our bankruptcy groups, remember there are also special rules for sending these notices if a borrower is to declare bankruptcy. And most of these have specific carve-outs, but that's something to be aware of is as soon as you start moving into the live contact and the notice requirements, is you need to be searching to ensure that someone inside of your institution didn't receive a bankruptcy notice of filing or a request to submit a claim in the bankruptcy estate, because it potentially could then impact contact with that particular borrower who is under the protection of the bankruptcy court. As I say, there are a lot of carve-outs that were put in place in the wake of the financial crisis to deal with those inconsistencies between the bankruptcy code and then the obligations under Reg X. But the drive home point here is ensure that somewhere in your procedure you have checking for that borrower status, whether he or she is a debtor and needs to be addressed specifically as you move forward. Thanks, Greg.
No worries. Actually, that's a very good point. I'd just like to play up that as well. Your bankruptcy coding, just operationally, we saw a decade ago that some of the bankruptcy codings weren't hard-coded in your core systems. If other loss-mid FTEs or other employees can go in there as you're onboarding people, they don't know what the coding means, make sure that things like bankruptcy coding is hard-coded and cannot be changed. We saw a lot of new employees onboarded during the last down cycle to handle these loss-mid procedures, and they would go into the system and uncode something like a bankruptcy code, which wreaks havoc with your compliance going forward if your employees are left. Okay, so inquiry versus application. I had the first two bullet points are examples of an inquiry. So you're going to want to make sure that the people processing the rise and default calls are going to understand what an inquiry is versus what an application is. And make sure your program documents that line and what that distinction. There are a lot of metrics and a lot of compliance, a lot of regs around what to do with an application, how to process it. Your timelines are very hard, very rigid if an application is received. Whereas an inquiry could be just a question. So you want to make sure that it's well thought out and documented within a procedure around loss man. If they're calling in just to ask the question, what is your program, what's available, that's not an application. An application is more like, well, I have A, B, and C, can I start the process? Make sure your frontline employees know the difference. Brad, the next slide. Successes and interest. All right, so this was where we saw a lot of process breaks a decade ago. You had, houses held within a family, elderly grandparents, death of a spouse, and the surviving spouse might not have been in charge of the finances, might not have known what was going on with the mortgage. These are the 5 definitions of the successors and interest within the loss mid regs and reg X. You want to make sure that your procedures are accounting for them. The worst one that I've run into about 9 years ago now, I had an AG calling me up when I was in-house, livid that we were not talking to a surviving spouse and just that we needed to speak to the estate of Williams, the estate of whatever the last name was. It was clear that the people we hired to start to process these loss mid packages didn't even know what the state of meant, and it created a nightmare reputational risk with the Attorney General. You want to be very clear in what is successors and interest, how they're defined, and what their rights are. How can you talk to them? How can they submit a loss mid package? How can you tell them what the balance on the loan is? How many days of default they are? Make sure they're provided for within your procedure. Randy, did you have anything to add to this?
No, I don't think so.
Okay.
Not on that one.
Next slide, Brad, please. Mortgage servicing transfers. We also saw a high volume of errors around servicing transfers. So when there's a pending loss mid application, there's now regulation around what you have to do with that. The servicer who's picking up the servicing rights has to process that application as if it was all received underneath them. You have to have a procedure in place to do this. If you're having a large bulk transfer, have a team or an individual, a single point of contact responsible for loss mid applications that are pending when that bulk transfer occurred. Make sure your complaint program, if you're starting to service a large population of defaulted loans, accounts for people who said they had pending loss mitigations. You want those escalated. You want to be able to look into them. If a borrower says they had a pending application with whatever their prior servicer was, and they haven't gotten a response, you want to know that that is being looked into as fast as possible. Then the timing of compliance. So this kind of speaks to how quickly you have to pick that up. All the timeframes are going to be applicable to you as the new servicer as they were to the old servicer. That's why you want to get them as quickly as possible if there is a complaint, or identify the issue as soon as possible to try to save from missing any of those timeframes that are now forced upon you as a new servicer. Brad, next slide. Randy, go ahead.
Going back 5 years ago, that was a huge area of litigation. And, that was a good way to get everybody sued and involved. You had the prior servicer, the new servicer. So, I think that is definitely something to keep an eye on as it's being transferred, because that was probably one of the top 3 types of litigation we were dealing with.
Continuity of contact. So again, this is where regs have now made or provided borrowers for a clearer path in loss mitigation. It also creates a greater strain on your FTE requirements. So servicers, here the continuity contact reg at 1024.40 requires a servicer to maintain policy procedures that are reasonably designed to achieve the following objectives. 1, assign personnel to a delinquent borrower by the time the servicer provides the borrower with the written notice that we discussed earlier. So that personnel can be a team or can be an individual, but you have to assign them. So and they have to be available. If you're going to experience a high rate of default, like that wave is showing is coming, you're going to need to make sure that you have the FTEs staffed here to do this. If you don't, it'll not only create a bad customer experience and a bad reputational risk, but also the regulators are going to be pulling these times and looking at your default. Remember, it's going to be hyper-focused in a year or whenever your next exam cycle is on default servicing, on your loss mid procedures. You cannot, the CFPB particularly is not going to take an excuse of, the default rates rose very quickly and we didn't have the ability to properly staff up. They're just looking at the consumer risk. So you should be focused on that. If you're within the compliance vertical, start asking the businesses, maybe send out an updated risk assessment. We'll talk about that later, the CMS impact, but kind of talk to the business lines about the turnover within the group, the FTE allocations to the group, and start raising those issues with your senior management to start to get ahead of it now. Second, make available to a delinquent borrower on the telephone with the ability to respond to borrower's inquiries, assist the borrower with available loss mid options, and have the borrower have the ability, without incurring a late charge, 2 consecutive mortgage payments in accordance with the terms of the permanent loss mitigation agreement. So the people that you're hiring are not just coming in off the street. They have to be aware of like the loss mid environment, or your training program has to be good enough to kind of educate the people that are dealing with your customer base as to what's out there. It's not just a matter of putting bodies in front of borrowers and then just answering the phone to be compliant with the reg, but rather the person who answers the phone has the ability. There's subsections of this reg that not only states that the person has to do this job, but also have access to your system. So the people that you hire have to come up to speed with your core servicing system, look at payment histories, look at prior applications, look at the servicing notes, and talk intelligently with the borrower. A large problem that we saw last go around was we were hiring people out of retail jobs just to increase the front lines, throw bodies at the problem. The regulators came back almost immediately saying, look, this isn't solving, this is creating more of a logistical net, it's creating confusion within the borrowers. They're not assisting the borrowers, they're just there to pick up a phone rather than a recorded line.
Craig, and one thing that may be worth noting as well for some of our participants on the phone who are at smaller institutions, remember that generally, with the exception of the prompt crediting rules and the error resolution rules, there were generally small servicer exemptions for these, and that's the magic 5,000 test amongst you and your affiliates, meaning number of mortgages under servicing. And that's set every January 1 is the test date for that. And so a lot of these that we're talking about in terms of continuity of contact, procedures, policies, et cetera, tend to apply just if you cross that 5,000 mark. And remember, there's a delay of either mid-year or 6 months to comply if you cross that exemption. But if you're anywhere near 5,000 or crossing over, you potentially are going to put yourself under the complete set of Reg X loss mitigation rules. If you're under that, you're not subject to you still are subject to a small servicer exemption. Then with the exception of those 2 sets of rules, generally these will only apply to the larger servicers. But something to be aware of, particularly if you're close to that magic 5,000 number. Thanks, Greg.
The one thing I would add to that is if you're under that 5,000 number and you are a small servicer, you will not be held to the standards of the reg, but you should want to be able to exhibit that you understand the regs, especially if you're getting close to that 5,000 number. Know what's out there and what the regulator is looking for large servicers and kind of apply those as best standards to you as a small servicer. I understand if you're nowhere near the threshold, you're not, you just literally will not have the capability from an FTE perspective to comply. But if you're starting to get up there, start to integrate them or integrate the requirements into the regs as a best practice. It goes a long way with the regulators to know that you're anticipating the growth and how you're going to adjust or scale your controls to meet that growth.
And Craig, let me put on my CRCM hat for a moment as well, which is we saw a lot of small servicers as well, who as they built their compliance management system, they tended to model it off of the Reg X rules as they developed their policies and procedures. And I think it's a great point you always make to me, which I want to drive home for our audience as well, is once you put that in a policy and procedure, once you begin offering it, you then have to commit to that. It does not become optional. And so a lot of compliance groups built their mortgage servicing procedures off of the model rules in Reg X, even though it may not technically apply to them because they fall under that small servicer exemption. But once you commit to that, you're now locked into that and you need to be following it appropriately.
Yeah, great point, Brad. Randy, I think you're up
the
for
next slide. Yeah. So as Brad mentioned early on in the presentation, with unemployment increasing, the strains on borrowers to meet obligations is going to increase. It obviously is pretty good potential that they'll struggle with making insurance premium payments and be in a position where we'll be dealing with force-placed insurance issues. Obviously, it's going to exponentially increase escrow payments, put a strain on the consumers who may be struggling to keep up with payments. One of the issues we're going to have when we're dealing with the forbearance issue is, are we forbearing principal and interest? Are we forbearing principal, interest, and escrow? If so, when you look at the escrow analysis the following year, how is that going to be impacted? As we saw during the mortgage housing crisis in 2008, the amount of force-placed insurance grew dramatically. So I think we need to consider the implications of obtaining force-placed insurance and other actions that are going to increase borrower escrow accounts, particularly since we're looking at the foreclosure and evictions must be delayed and the forbearance direction under the CARES Act. And Craig, I know you and I had talked about some force-placed insurance issues that you had seen in the past. I don't know if you wanted to discuss a few of those or.
Yeah, operationally, I think it's a good time to look into your whatever system is controlling your escrows or your insurance tracking. Some core systems have limited lines to which to track escrows, and then there's certain areas of the country that you'll start to see, homeowners and taxes as well as wind insurance or a certain type of, location-specific insurance, and they tend to cycle off if the core system doesn't have the ability to track more than two. Generally, it's not an issue when the majority of the portfolio is performing. When those defaults start to rise, you'll start to see borrowers that are lacking on a payment, and then or not, no notices are going out, but yet you're creating the force-placed policies, and this just drives the borrower further into default. You have to be focused on any law of force-placed policy that's out there, the ability for the borrower to come back from that, and how the regulators view it. So look at your core systems, make sure that you're tracking all the policies that are applicable, or if there's a problem there, can you kind of create a workaround or a control that's accounting for it.
All right, Brett, and then the next slide, dealing with the SCRA. I think there's two provisions, obviously, that we're dealing with: the 6% interest rate cap, which obviously I think when we're talking about mortgages, most folks are less than a 6% interest rate. I think it's really going to impact credit cards and it's going to impact auto loans. And I think where this comes into play is with a lot of National Guard members being called into active duty. It's the responsibility of the service member to provide notice of active duty. What is probably most impactful is that they have 180 days or 6 months after active duty to provide that notice. So that would require retroactively going back, on some of those credit card accounts, auto accounts, reducing to the 6% capped interest rates. There are also the non-judicial foreclosure rules that are applicable, and those are listed there. And Brad, if you could go to the next slide.
Yeah, before we do, we did have one question sent in by the audience we wanted to address, which is the use of sub-servicers for the small servicer exception. The small servicer exception applies to you and your affiliates aggregated. So if you had, say, 4,000 mortgages under servicing at the mortgage level and you had an affiliate mortgage company, the affiliate think bank holding the control acts that deal with, do you have control over the other party, the BHC definitions. And so if you do have an affiliate that also has, say, 2,000, that pushes you as an organization over the 6,000. To the asker's question, a subservicer who is servicing more is subject to the large, to the mainstream rules. It doesn't allow an exemption, even if the loans it is servicing are from a small servicer. But you as an institution, if you're using a subservicer, you don't then count the number of loans being serviced by the subservicer. Instead, it is truly the number of you at the institutional level amongst you and your affiliates, and it flows one way but not the other, meaning the small servicer exemption does not apply to a subservicer who is servicing for a large, but it could flow the other way where your subservicer may have 100,000 under servicing and you as an institution don't, and you don't have to, in essence, recognize the subservicer. Thanks so much, Randy. Just want to make sure we pick that up.
And Brett, I think one thing I should mention about the SCRA is that as of right now, there's not an amendment to the SCRA. It's going to continue to operate as it has. I think that the biggest issue here is that with so many being called into active duty through the National Guard, I think that's where the potential impact is. So we need to make sure we're paying attention because it's going to have a bigger impact, than it has the last few years.
Yeah, particularly if you have cars or auto or indirect auto lines, we foresee this being an issue because you potentially have some, above 6% loans that are floating out there that potentially could be triggered.
And the non-foreclosure continues to operate. So. Sorry, Craig, go ahead.
The one thing I could stress under SCRA, you can't underestimate what a reputational risk is involved by an SCRA violation. If you weren't doing this 10 years ago, there were multiple banks that were foreclosing or referring to foreclosure people that should have been under SCRA protection. A lot of it has to do with the training on the front end. People don't understand that the act applies. A lot of lenders and servicers have gotten better with their procedures coming out of the last downturn. But if you're within a compliance vertical, you want to make sure this is another area that you want to see complaints escalated. I've had institutions, starting to escalate like airline captains because captains was a trigger term that they wanted to see in a complaint. Just anything that could even infer that the borrower or a spouse of the borrower was in the military. You do not want to foreclose on an SCRA protected borrower. It's not just the regulatory risk, but the reputational risk is just completely outside.
That's a great point.
Fair lending impact. So with loss mitigation, we talked a little bit about this on our last in the trenches session. ACOA and the Fair Housing Act is applicable not only to origination, where most people think of it, but in default as well. So you're going to want to look at your loss mitigation procedures, the products that you're putting out there, how you're getting the word out to defaulted borrowers that the options are available. You're going to want to apply your fair lending controls to these processes. You want to make sure that you're not, having any disparate impact within the loss mitigation portfolios. You don't want to ask any questions in your loss mitigation applications that could indicate a disparate impact or a disparate treatment in any way. A lot of lenders and some servicers don't recognize this as an area of risk, but as the default rate increases, you're going to see those fair lending departments shift right from origination over to your loss mid practice and your default practices. The other high risk area here is LEP issues, limited English proficiency. Again, we talked about this during our last session a little bit as well, but as you're building your loss mid procedures, as you're building your default procedures or you're reviewing them, make sure that your origination procedures or cover the same languages. If you originated in only English, fine. If you originated in Spanish or a native language that's spoken in your footprint, make sure your default silos can handle that as well. You want to make sure that there's, you're not just translating packages, origination documents to borrowers on the sales end, but you also want to help those same population of people on the default side as well. There's multiple pieces of guidance out there from the CFPB and from HUD stating that, language translation can have directly indicate a protected class or indication of a protected class. Also, the CFPB says, if you're going to offer different languages, they want you to focus on your default spaces, not origination spaces first. So be aware of that as the default rates rise. Next slide, Brad. Community Reinvestment Act. As we're talking about loss mid, if you haven't been in the space before, you're just starting to put out loss mitigation options, make sure you're aware that you have to aggregate any effort that you're doing here. any programs that you roll out, make sure you're capturing all the forbearance agreements, any of the mitigation covered in the loss MIT mods, and kind of integrate that into your CRA strategic plan. The community outreach that you're doing, if you're working with LMI areas or at-risk areas, make sure that you're capturing all of that. So it's not just protecting your credit portfolio, the creditworthiness of the loans, but also, how you're interacting with your community. That's all going to be very useful in the coming exam cycle. And you want to make sure you're starting to use those building blocks now, or at least have the data to build that CRA strategic plan out come exam time. Next slide, Brad. Third-party oversight. We do want to focus if you're just a lender, holding the paper. If you're using a private label service, you're going to want to start to look at do those servicers have delegated authority for you? Are they aware of what your loss mid options are? If you're changing your loss mid options given the changing default environment, are you communicating that timely to your servicers? Are you managing the reputational risk? So are you seeing complaint reporting coming in from the sub-servicers or the private label servicers? Are you seeing escalations come in? You should be reviewing your master services agreement with these providers and making sure that they are complying with the agreements. As those default rates rise, your sub-servicers are going to start to see a greater volume of complaints. Your regulators are going to come in there and start to, ask questions about that. Are you monitoring their complaints? Are you looking or evaluating the sub-servicers in a manner that's accounting for the rise in complaints? Or are you addressing them with the sub-servicer in any material way? Also, you start to want to look down the road a little further as you start to see increases in foreclosure referrals and contested litigation. You're going to want to start to look at your property preservation and foreclosure vendors. Are you vetting those law firms? Have you looked at them in a while? Are you doing file reviews on site for them? Are you doing background checks for your property pres people? Are you, again, looking at their complaints or their issues? Are you tagging any property pres issues within your complaint program for escalation and heightened review if you start to see an increase in that space? Brad, next slide. CMS, we have addressed some of this, but we're going to talk about it in greater detail on Thursday. But within LossMit, you know that the regulators are going to be in your offices within a year or a little bit more than a year. So you're going to want to show them that you're, aware of the shifting risk out there for consumers, that it's no longer in your origination silos that might be more heavily weighted in your defaulted portfolios. You're going to want to look at your monitoring and testing schedules. Make sure that you're covering FDCPA, SCRA, FCRA at a rate and a frequency that's more applicable to the current environment than the environment that existed in January. You might want to be looking at your collection procedures or collection vendors, once or twice a year now if it was on a biannual schedule. You also want to start documenting and reporting to your board, or if you are a board member or are senior management, start asking questions of your risk verticals as to how you're managing the shifting environments. What is changing within your CMS? The regulator is going to look for a top-down management approach to compliance. How are you going to show that to them in months to come? Do you have your board minutes reflecting the anticipation of default rates? Do you have your board minutes reflecting, FTE concerns, or that you're proactively looking into these silos that we discussed over the hour to kind of identify risk? You want to show that you were thinking about this, and even if, a business decision is made the other way, at least you can start to craft the narrative around that you were aware of the shifting risk and manage it the best you could. The last thing you want to do is be caught in a review in a year from now and then ask, well, how come you didn't do anything? If you didn't have the FTE bandwidth to cover it, fine, but at least showcase that you knew what was going to hit the bank. That's one of the first steps you could take. Brad, next slide. Oh, Randy,
we expect to see a surge in tax sales, and this dovetails on the force-placed insurance discussion we had just a few minutes ago. But in addition to the escrow trappings that will be found with regard to force-placed insurance and tax payments out of escrow, there's also a significant risk for non-escrowed items. There's several non-escrowed utility bills, if they're not paid by the borrower, they'll prompt a sale that will extinguish the mortgage if not discharged or redeemed. I've included a couple states where we see this a lot. Rhode Island, in addition to municipal property taxes, there are various authorities, commissions, and districts that will conduct sales and sell collector's deeds once or twice a year. Obviously, the timing of those sales is going to be affected by COVID, the payments, the borrower's ability to make those payments. In Rhode Island, there are 42 fire districts alone. And as Craig was saying, a lot of those, the system may not even have a place to monitor those. 31 water suppliers and regional sewer districts. So the risk here is not just your traditional escrowed property tax and insurance, but also these other obligations that, one, you may not be monitoring, or two, you may not even be aware to be monitoring. Same with issues in New York that I've got there. And you see that they're postponing sales through May, and I expect those sales to be postponed even longer. One of the things that we are putting together is a comprehensive list of these types of issues in a state-by-state format that you should be looking for. And we're also putting together a list of when the sales are going to be postponed to, or how they're going to be affected. So if that's something you're interested in, feel free to call Craig, Brad, or myself. And Craig, I knew that you had some experience with that in-house, if you wanted to just briefly touch upon.
Yeah, one thing I would add here is if you're not having someone monitor this for you, it does turn into a logistical nightmare. You won't be able to track, the local municipalities' disparate approach to some of this billing. And as you start to see default rate rise and tax revenue or county revenue decline, you'll start to see, desperate county and local municipality approaches to try to collect. One of the nightmare scenarios I ran into last downturn was certain counties in Texas were issuing arrest warrants for CEOs when there was a lack of payment on multiple properties. If it went to REO or if it went to tax sale and the borrower had defaulted or was in the wind, the municipalities were looking to the bank of record on the mortgage and then going after senior management. And they would never actually arrest them, but when they started to send in the arrest warrant, they got that handled quickly. So just, it seems like it's not high risk, but it starts to become very high risk, especially if you're dealing with a large footprint. Yeah,
and I think that this is something in normal times that it probably is of limited concern, but when you see the escalation of unemployment and requests for forbearance and modification, you're going to have more and more borrowers struggling to pay their mortgage payment and literally just survive. And so a lot of these other obligations are going to fall by the wayside, and it's not going to be too long until all of these taxing authorities are going to be looking for money to survive. So I think having a plan in place or having a partner in place that can help you monitor these and then also monitor the sales themselves is going to be important.
Next slide, Brad. Oh, okay. We're going to wrap this up quickly because we're running out of time here. We want to leave some time for Q&A. The one issue that's still developing, if you're a small independent mortgage bank or a servicer and you're required to forward these payments for the loans on the GSEs, it's going to become a nightmare scenario very quickly depending on how quickly the default rates rise. The Mortgage Bankers Association estimated that if a quarter of borrowers' requests are granted for loan forbearance in the next 6 months or shortly, it'll result in a $75 billion to $100 billion hit to mortgage servicers. So the NBA president is reaching out to FHFA and Treasury saying, look, we need to create some kind of liquidity facility here to ensure the stability of the servicing industry. We don't want to see a lot of servicers start to run into bankruptcy issues. They will not have the capital requirements to move forward if these rules aren't changed. This is developing, and it's going back and forth between the government and the NBA mostly. But you should be monitoring it if it does affect your institution. Next slide, Brad. I think this is the last one. This is just some recommended guidance that we wanted you guys to have. if you're going to start to look at your defaulted portfolios or your default lines, even if you're not regulated by the CFPB, all this guidance is applicable to your institution. And this is what came out over the last decade. So you'll start to see, the years there, when it was published. It's well worth it to pull these bulletins and just make sure or distribute amongst your compliance groups or the business units themselves to make sure that, these issues are on top of mind, because they will be on top of mind of the regulators when they come in, in 2021. And I think with that, is that the end, Brad? Yep.
That's exactly right. And so
Craig,
now we'll open it up for, go ahead, comments or other.
I was just going to. All right, Brad, go ahead.
No, I was just going to say, if anyone would like to send in questions, feel free to on the question forum here. But you're also we're going to continue to chat here for a while. Those questions can be on any topic whatsoever, so feel free to raise them. But we're going to continue on here for a while. Feel free to send those questions if you should have them inside of the comment box, and we'll work to respond to them. Go ahead, Randy. Thank you.
Yeah, I was just going to say, with regard to tax lien questions, Carl Fumarola in our Boston office is also well versed in that. He helped me put together some stuff. So questions in the Northeast, he's a great contact. Also, Craig, one of the things I was going to comment on, and I think I missed my opportunity when we were talking about the loss mitigation packets and the information and some of the issues we saw, 7-8 years ago, and when I was handling litigation as a younger attorney, dealing with documents timing out and stale documents, and policies in place, to address situations where, a driver's license, for instance, has been provided 5 times, but loss mitigation application is denied because the documents grew stale and the driver's license wasn't provided for the 6th time. And being on the side of it in litigation, that's very difficult to be in front of a judge and explain why you needed the driver's license for a 6th time. So I think some of those issues are easy issues that can kind of be addressed and waded through now to avoid some of that senseless litigation. I think you said you had some experiences in Florida where, it was made difficult for litigators during that time too.
Yeah, we had counsel a lot in Florida, a lot of South Florida, Dade County around and surrounding areas, refusing to go into court because they would be the ones being held in contempt when the servicer couldn't get the records over to them, or just process the applications in a timely fashion. The foreclosure counsel and contested foreclosure counsel were bearing the brunt from the judges, and the judges do not care.
Yeah, and those issues are almost impossible to fix on the back end, but those are things right now that if they're addressed, I think can save a lot of headache and heartburn, 3-4 years down the road.
All right, any questions from our audience here? Feel free to send those in. We'll be happy to answer those. Obviously, if you have additional questions, feel free to reach out to any of the presenters, or if you're an existing Nelson Mullins contact client, we have teams assembled to deal with all of these. We've got a working group that's specifically dealing with consumer loan modifications and response to COVID-19. We've got a separate group that's working on small commercial, another that's working on mid-sized commercial. Additionally, on our website, there are resources regarding response to the COVID-19 crisis, and those are focused specifically on business continuity, as well as the financial services series that we have. There's now probably all said 20 to 30 different client alerts and presentations that are available inside of that portal, specifically focused on the financial services industry. And so, would certainly direct you there for resources, or any of us are happy to do this. We're working to help all of our clients through this process. And so reach out to any of us. We'd be glad to help you. And we just thank you for being in the trenches and for helping these various customers through this very trying time. And so we realize you're on the front lines, and we want to be a resource for you. At this time, if there's no more questions, we'll go ahead and stop. Thank you for spending some time with us this morning. We hope to see you next Tuesday as we start talking about the logistics and implementation of the Main Street Loan Program, or this Thursday as we're talking about adapting your compliance management system and some of the ways we've been working with our clients to do that. Everyone be safe, be well. Special thanks to our presenters, Randy Saunders and Craig Nazzaro today. We'll talk to you next Thursday or next week. Thank you.